Markets crash. It's not a question of if, but when. The question is, what do you do when the stock market crashes? Not a dip. A full-on red panic sell crash, like 2000, 2008, or 2020. What would you do? Panic? Sell? Freeze? Some portfolios? They don't flinch, especially Warren Buffett's. They're built with stocks that hold up in chaos. Businesses so solid that they've weathered every storm for decades, through the dot-com bust, the 2008 financial crisis, the COVID crash, and more. So, what stocks can do that? In this video, I am breaking down 5 of Warren Buffett's strongest, most crash-resistant stocks, picks he's owned for years and stuck with even when everything else was falling apart. I will show you how each of these companies performed during the last 2 major market crashes, what makes them so resilient, and what it all means for regular investors trying to build something stable for the future. He doesn't sell when the market panics. He doesn't trim during a recession. He does almost nothing. And that's the move. During the 2008 crisis, while banks were folding and stocks were falling 50%, Buffett was doubling down. In 2020, when the market dropped 34% in a single month, he didn't dump Apple. He didn't exit Coca-Cola. He didn't touch American Express. One of the stocks is so explosive that it can turn a $10,000 investment into $3 million, a 3,000 times return. But first, let's look at Buffett's crash strategy. Most investors try to avoid crashes. Buffett builds for them. He knows market meltdowns aren't a matter of if, they're when. And while everyone else scrambles to predict the next dip, Buffett focuses on something way more powerful: preparation. His strategy is simple, but it's not easy. He buys businesses with wide moats, companies that are hard to compete with, essential to daily life, and built to last decades. Not months, not news cycles, decades. He looks for pricing power, strong cash flow, and management teams that don't lose their minds when the headlines get scary. And then, he holds. That tells you everything. Because if you want to know what Buffett really believes in, look at what he refuses to sell, even in a crisis. That's why these 5 stocks matter. They've been tested, they've been hit, and they've come out stronger. Now, let's break them down one by one. If you had to pick just one stock to represent Buffett's entire philosophy, it might be Coca-Cola. He started buying KO back in 1988, over 35 years ago. And today, he still owns 400 million shares, worth nearly $25 billion, or about 9.3% of the entire company. So, why has he held it so long? Because Coca-Cola is more than a soda company. It's a global habit. It sells over 1.9 billion servings a day across 200 plus countries. And in good times or bad, people drink Coke. Now, let's look at how it held up in the worst crashes of the last 25 years. During the dot-com crash in the early 2000s, while tech stocks were dropping 60 to 70%, Coca-Cola fell around 30% and recovered by 2004. In the 2008 financial crisis, the S&P 500 dropped 57%. Coca-Cola, just 26%, and it was back to pre-crash levels by 2010. Then came the COVID crash. The market tanked over 30% in a matter of weeks. KO dipped only 17% and bounced back in 5 months. Even during a pandemic, people still grab a Coke. And that's the point. Now, let's look forward. If you invested $10,000 into Coca-Cola today and just let it sit, here's what that future could look like. After 10 years, it grows to $22,509, more than doubling your money. After 20 years, it will climb to $49,431. And by year 30, that one investment becomes $106,149. That's a 10.6x return. This is the kind of slow, steady, disciplined return that doesn't make headlines, but it does build lasting wealth. Coca-Cola isn't exciting, it's just reliable. And for Buffett, that's always been more than enough. Next up, I have Chevron, CVX. Chevron is proof that Buffett doesn't just invest in snacks and software. He's all in on energy, too. He owns nearly 7% of Chevron, one of the world's largest oil companies. That position is worth billions. And while it's faced its share of controversy, the financial story is impossible to ignore. Chevron is built to handle volatility. It's survived oil crashes, price wars, and geopolitical shocks, and yet it keeps pumping out cash. Let's look at how it held up during the market chaos. During the dot-com bubble of 2000, it barely took a hit. In the 2008 financial crisis, Chevron fell around 40%, a tough hit, but not unexpected in the energy sector. It rebounded as oil prices recovered and demand stabilized. In the 2020 COVID crash, it dropped about 30%, but recovered within 6 to 8 months, right alongside the sharp rebound in oil and gas prices. Fast forward to its recent Q4 reporting, Chevron pulled in $49 billion in revenue, beating Wall Street expectations. It raised its dividend by 5% to $1.71 per share and returned a total of $27 billion to shareholders in 2024 alone, through dividends and buybacks. It also just acquired Hess Corp for $53 billion, a massive move that expands its reserves and strengthens its global reach. The company says it expects to double its free cash flow by 2026, even as it trims operations to save another $3 billion. This is what Buffett likes: capital discipline, high return on capital, and a steady stream of shareholder rewards. If you put $10,000 into Chevron today and held for the long haul, here's what could happen. In 10 years, that investment could grow to $25,645, a 2.5x return. In 20 years, it could climb to $69,561, or nearly 7x. And by year 30, you're looking at $201,079, a 20x return. Next recession-proof stock on my list is American Express AXP. American Express is the perfect example of Buffett's patience in motion. He's held this stock for decades, since long before the dot-com crash. And even when it took massive hits, he didn't flinch. Why? Because he wasn't investing in a credit card company. He was betting on trust, brand loyalty, and long-term customer behavior. Let's see how AXP performed when the market was on fire. In the worst way. In the dot-com crash, American Express dropped around 45%. Not great, but it recovered by 2004, while many dot-coms disappeared completely. Then came the 2008 financial crisis, and AXP was right in the blast zone. It fell nearly 60%. But Buffett didn't sell. In fact, he increased his stake. And sure enough, the stock fully recovered by 2014. And in the 2020 COVID crash, American Express fell about 35% but bounced back within just 6 months. Buffett knew what others didn't, that American Express isn't just about transactions. It's a premium brand with sticky customers who don't jump ship when times get tough. As of 2025, Buffett's position in AXP is worth around $45 billion, making it one of his largest holdings. It's also a consistent dividend payer with a fast-growing payout, driven by strong earnings and a lean-focused business model. If you invested $10,000 into American Express today and simply let it ride, the long-term outcome would be powerful. After 10 years, your investment could grow to $37,529, more than 3.7x. By year 20, it could be worth $138,012, a 13.8x return. And by year 30, it could reach an incredible $499,408, a 49.9x return. American Express rewards those who wait, and that's why it stayed in Buffett's hands for over 3 decades. Next on my list is Moody's, MCO. Moody's might not be flashy. It doesn't make products. It's not a household name. But to Buffett, it's one of the most quietly powerful businesses he's ever owned. He first invested when Moody's went public in 2000, and he's held it ever since. Why? Because it owns a critical role in the financial world: credit ratings. When companies, governments, or institutions want to raise money, they go to Moody's. It's an industry that has high barriers to entry and few serious competitors. Let's talk about resilience. During the dot-com crash, Moody's dropped about 10 to 15%, but recovered within a couple of years. In the 2008 financial crisis, it fell roughly 50%, but rebounded fully by 2012. And in the 2020 COVID crash, it dropped just 15% and came back in a matter of months. That's impressive for a company so tied to global credit markets. Now, let's look at its strength today. Moody's consistently posts strong financial metrics, with a profit margin over 29% and a return on equity north of 70%, thanks to its asset-light, high-margin model. As for the future outlook, in 10 years, with a $10,000 investment, you could be looking at $49,656, nearly 5x your investment. Over 20 years, that could grow to $240,752, or 24x. And in 30 years, that turns into $1,151,830, a 115x return. Next and final stock for today is Apple, AAPL. Apple is the stock Buffett once avoided, and now it's his biggest position by far. He started buying in 2016, long after the iPhone was already dominating the world. It was a rare tech bet for him, but in his own words, Apple isn't a tech company, it's a consumer product company. He saw what many missed: loyalty, repeat purchases, and a moat that gets wider with every device, app, and service. And Apple has more than proven its resilience. During the 2008 financial crisis, it dropped about 50%, but recovered fully by 2010. In the 2020 COVID crash, Apple dipped only a few percent, then recovered in a matter of a couple of months, reaching new highs by the summer of 2020. Now, Apple isn't just selling phones. It has over 2.2 billion active devices globally. Its services business is growing 19% year over year. That includes Apple Music, iCloud, App Store fees, all recurring revenue that doesn't depend on iPhone upgrades. Buffett's now sitting on more than $75 billion worth of Apple, making up over 28% of Berkshire's stock portfolio. A $10,000 investment in Apple today could become one of the greatest compounding stories of your portfolio. After 10 years, it could grow to $70,461, a 7x return. In 20 years, that could expand to $488,383, a 48.8x return. And if you let it run for 30 years, you're looking at $3.37 million, a staggering 337x return. Buffett saw what Apple had become, not a gadget maker, but a global ecosystem people can't live without. And that's why he bet big, very big. Let's step back. We've just looked at 5 stocks Warren Buffett has either held through massive crashes or added to his portfolio during periods of fear. These aren't just successful companies, they're survivors, and that's the key. The takeaway can be simply explained in 3 steps. First, resilience matters more than excitement. Some of these stocks, like Coca-Cola and Chevron, may not be flashy, but they deliver steady returns, rising dividends, and peace of mind over time. Second, moats protect your money. Apple has a moat in its ecosystem. Moody's has a moat in its near monopoly on credit ratings. American Express owns its niche in premium financial services. Third, you don't need to time the market. Buffett never tries to predict when the next crash will hit. He just makes sure he's holding companies strong enough to withstand it and recover faster than the rest. If you're building your own portfolio, think about creating a crash-proof core, a set of 4 or 5 stocks that are diversified, consistent, and built to last. Stocks you won't feel pressured to sell, even when headlines are screaming. 3 major crashes, 5 battle-tested stocks, and 1 simple truth: wealth isn't built by avoiding risk, it's built by preparing for it. So ask yourself, what does your portfolio look like if a crash hits next year or next month? If you want to build a future that isn't shaken by headlines or fear, maybe it's time to think like Buffett. Start building your own crash-proof core.